Good morning or good afternoon to you, wherever you are. My name is Stephen Wall, co-founder of the Wealth Mosaic, and welcome again to the next edition of our WealthTech Talks. Today, I'm joined by Dan Jones from Oliver Wyman Digital and by Boris Rankov from Incube or Finantics. Good morning to you both.
Good morning.
So today's session, we are looking at upscaling advice through next best action. So I will be having a conversation with Boris and Dan today to talk through that topic. Obviously, in a modernising wealth management marketplace where we're moving towards a more advisory model, and we're looking at more insightful advice, more personalisation, and we're looking at the use of technology to support that process. The idea of next best action, or the capability of next best action, is highly relevant to that journey. So today we're going to speak to Boris and Dan about that topic, run through a little bit of a Q&A. Boris will do a quick introduction through some slides, and then we'll go into a quick conversation. We have up to an hour with you today. If you have any questions, feel free to ask them. The question box is always available for you to drop your thoughts in and see with the audience, see if you've got any questions, and we can come back on those. If I quickly turn it back to Boris and Dan. So, Boris, quick introduction to yourself, what you do, and we'll move over to Dan.
Sure. So my name is Boris. Hi, everyone. I'm based in Zurich. At Finantics, I'm responsible for our digital advisory product. Before joining Finantics, I co-founded Incube Group. It's a Swiss-based financial technology company based here in Zurich, very focused on applying machine learning to various use cases in wealth management and banking. And at Finantics, we are now integrating our next best action capabilities and modules into the overall Finantics platform that we also deliver to our clients worldwide.
Thank you, Boris. And Dan, you for a quick introduction, please.
Yeah, hi everyone. Dan Jones. I'm a partner here at Oliver Wyman Digital. I'm based in Hong Kong. I've been here around 2 years now, and I guess my background and the types of projects that I've been involved with has always been with financial institutions that are looking to obviously maximize the use of some of their data. And next best action is an area that we've seen a huge amount of interest and activity in over recent years. So we're currently advising a range of financial institutions on how best to do this, how to find that additional value, and really take advantage of the increasing familiarity of clients with recommendation engines and the concept of next best action.
Perfect. Thank you, Dan. So thank you to both. So we will move to a discussion shortly, but firstly, Boris, you've got a few slides that you want to introduce the concept of action to us with. So I will turn it over to you for the next 5 minutes and listen to that.
Yeah, so let me, before we start the discussion, give you a quick introduction what we understand on the next best action. And of course, there are various drivers for personalization in wealth management. We'll only very briefly touch on that because we will have later the discussion. So like reaching new markets like mass affluent, increasing the sales effectiveness of relationship managers and financial advisors so that they can, convert more by providing personalized investment proposals and trade ideas. But it's also about increasing front office productivity, so enabling wealth managers and relationship managers to serve more clients more efficiently. And of course, there is also competitive pressures like new incumbents, big tech companies, fintech companies entering into financial services markets, and they already utilize lots of data to provide personalized services. So there are many reasons why wealth managers are looking at personalization, to embed personalization into their advisory process. We will have an in-depth discussion later together with Dan and Stephen. Another, let's say, important topic is that you see in wealth management companies and in banks, there is like a shift from brokerage or execution-only models to advisory. And also this, you have to provide added value to your clients. Why should they pay a fee for getting advice? And you as a wealth manager have to offer added value to them. You have to offer personalized advice. So in order to convince clients to move from a brokerage execution only model to an advisory model. Also that we will discuss later more about. Let me give you a quick introduction on what we understand under next best action and why we think it's relevant in the wealth management industry. If you look at the typical process within a wealth management company, where you have like top down the house view, and you would like to distill that so that you can provide the right content to the right client at the right time. So how do we come from house view to recommended for you? And typically top down, you have a huge investment opportunity set where clients and consumers can invest in. And it's the job of the wealth manager basically to do all the research, on the macro environment and the economic environment, on foreign exchange developments, on interest rates, global interest rate developments, on credit opportunities, in which stocks to invest, etc. And the result of that is they do research, they produce forecasts, they make recommendations how and where to invest, they create investment strategies. So it's lots of, let's say, recommendations that are created out of this research. And based on that, different, let's say, products are offered to the market and to the clients, like, strategic asset allocations, tactical asset allocations, model portfolios for discretionary management, and focus and recommendation lists across different asset classes that are then provided to the front office staff, which is relationship managers, investment advisors, and they have to do the matching of all this content coming top down to the specific clients. And when you look at the advisor itself, he sees like the funnel in a reverse direction. So a financial advisor or relationship manager typically within a wealth management company or private bank serves 50 to 300 clients in his book. At the same time, he's receiving all this information, and has to deal with all this information. So has to know about the bank's house view, the recommendations across the different asset classes, what is going on in the markets, what is going on in different companies, what are the events. At the same time, the advisor has also to know his clients, know about life events, what are the goals and preferences of clients, in order to know how to best advise them. And all of this is embedded in a highly regulated environment. So the advisor has to follow many regulatory rules at the point of sale. So he has to be aware of, what can he propose to a specific client based on different parameters, like what is the risk profile of the client, what is the current portfolio of the client, where is the client living, in what is the domicile country of the client. Maybe he has to consider cross-border restrictions if the advice is given across the borders. And without technology, it would be basically impossible to fulfill these tasks. And the consequence of this is when you don't use technology or not enough technology is that the advisors are passively advising their clients. Maybe they are proactive on their wealthiest clients, where they have like a regular exchange and they are very active. But for most of the other clients, the relationship is often very, let's say, passive, and the advisor is providing advice when the client is calling and asking for advice, or when the client wants to do some trade, he's asking about what do you think about this stock, and then the advisor is providing advice. And the question is that we asked ourselves, when you look at other industries, in the consumer industry, for example, the utilization of recommendation engines is much more common. So when you look at Amazon, Spotify, Airbnb, all these, let's say, online service providers, they utilize the data they collect about their clients and make personalized recommendations, for example, about the next flat, where to go to holidays, or create compilations of music that you can listen on Spotify. And of course, this is needed there because these, let's say, industries or these providers, they have millions of clients and they have millions of products, and they have somehow to match that. And we asked ourselves whether we can also apply this technology in financial services, because also there it's about proposing something to clients, proposing tailored advice. But the more tailored the advice is, the better the client feels, advised, and also the higher the chance is that the client will accept the proposal. In order to do that, the question is what kind of data is available within the banking context. So typically, what we want to do is we want to collect data about clients and data about products, and then utilize machine learning and rules in order to make the perfect match. And there is lots of data about clients, of course. It starts already during onboarding. The bank has to collect all the information about the client, about the source of his wealth, income, etc., family situation during the KYC process, so that bank is sure the client can be onboarded. Then it goes on with doing investment and risk profiling. So what is the risk aversion of the client? What are his investment objectives, etc. Once the client is, let's say, onboarded, is live with the bank, there is much more data about the client, like what is the current portfolio holding, what are the historical portfolio holdings. Maybe bank also has some data from financial planning, knows about cash flows and goals of the client. And more banks are also, as they are digitalizing front office, so offering mobile apps, digital client portals, etc., even chat systems to their clients. You also have data, click data, for example, in these different digital channels that you can utilize in order to study the client behavior, to do profiling on client behavior. On the right-hand side, you have lots of data on products. So you have asset reference data. You have equities, you have fixed income, you have mutual funds, ETFs, structured products, and all of this data, or all of these products, you have lots of data, like currency, sectors, ratings, payoff profiles. You maybe have ESG data, so that you can classify products to different ESG topics. And you also have lots of publications that is produced by research, for example, on different trends in the market, market outlooks, but also on different product launches, like a new private equity fund or a new mutual fund that was launched. And all of this data you can also utilize in order to do this match between client and product using different recommendation machine learning algorithms. So that's as a quick introduction into what next best action or what recommendation engines mean in the banking context. Back to you, Stephen.
Thank you, Boris. Much appreciated. Very insightful. A lot to go on there. I think the topic of networking advice is an interesting one. I'm sure could be debated by the traditional wealth industry, but we'll probably come on back to that later. Boris, if I could just come back to you first of all. You ran through a range of drivers there. Would you like to talk to us about? So there's many benefits here. There's many reasons why this might be happening. Personalization is right at the center of it. But if you think about reaching new markets, digitalization of new channels, increasing sales effectiveness, where are you seeing the biggest driver now? So what's pushing this onto the industry or bringing it into the industry from the perspective of these drivers?
Yeah, I would say, as we know, let's say major initiatives that most banks and wealth management companies is digitalization of front office. So, digitalizing everything that has a client impact. That means start from onboarding, so making onboarding as seamless and as fast as possible, so that clients can, open an account with a new bank very fast, and it doesn't take tons of paperwork and it takes 2 weeks. Then, offering tools to the relationship managers and advisors so they can efficiently serve their clients, like having an advisor dashboard where the advisor sees all his, all these clients in a 360-degree view of his clients, and then offering digital tools also to clients itself so they can access the services of the bank and the wealth manager also through digital channels like client portal, logging in, looking at the own portfolio, looking at some news. So there we see lots of activity, and of course, if you do that, advice can happen anywhere, anytime, right? Because clients have access through these digital channels to these services, and Also, more data is collected. You see like what clients are doing in these channels, which documents they are opening, when they log in, how often they log in, how often they trade, what they trade. So all of this data is of course collected within these, let's say, initiatives. And here we see like a big interest, from wealth managers and banks here to provide highly customized and personalized client experiences. So that means in terms of content, so that whatever they receive in terms of content, it might be a publication or trade idea, is highly personalized to them, so that clients have a high affinity, but also in personalizing the look and feel of the digital experience as well, that they only see the information they are interested in. It might be some clients like to have more analytics, or the clients have to have like more simple look and feel of the user interface. So here we see like a big demand from the market.
Thank you, Boris. And if I could bring you in now in terms of drivers and perhaps adding to what Boris has already said, or maybe adding other elements to it. Would you largely concur from your experience of working in financial services firms?
Yeah, I think what we're seeing is two main drivers in particular in Asia as well as, but also financial services, and that's really that customers, clients are more and more familiar with having recommendations made to them from digital platforms. They're getting more comfortable, they're getting more educated around how that works. So I think that is becoming more familiar than perhaps going for a face-to-face consultation with an RM or wealth manager, and in particular in the emerging affluent, so the upper end of mass and mass affluent. Of course, those are the segments that are really rapidly adopting these types of interactions at scale, and we've seen that in particular in places like China. The success that Ant has had with its investment platform Yubao, it's using that change in familiarity of customers with these types of platforms, but it's also coupling that with the second main driver, which is the huge increase in the amount and availability of data. So we are seeing more and more opportunities to pair device data with behavioral data, with social media data, to really start drawing conclusions about client wants, needs, and ultimately behaviors. And that can allow us to make those informed, relevant recommendations to clients. So I think ultimately all of that is leading to an opportunity to upsell more, to cross-sell more, and get more return on your marketing dollars. So I think in particular those two areas we're definitely seeing in financial services.
Perfect. Thank you both. You've both mentioned several big techs, several entities that are indeed, certainly in Asia, maybe less so elsewhere, but probably it's coming. They're pushing into financial services. So we've talked about, or you rather, you've referenced Airbnb and now Amazon and Netflix and others. So are these entities going to be seriously disrupting? I mean, are they acting as solely as influencers of what can be done, and therefore financial services will just take over in this realm, or are they really going to push in and act as a threat, as many fear? Do you have a view on that quickly here in this topic?
I think if those firms in question choose to go into financial services, then they have the existing customer bases to distribute to. So there's absolutely potential to disrupt things, but obviously they need to be regulated institutions. They will most likely need to partner with institutions or get their own licenses, depending which market they're looking at. So I don't think it's as straightforward as many would believe in terms of if big tech comes into this area, they will simply take over. I think there is a lot of embedded knowledge and capability in the financial institutions that have offered wealth management products for years. I think what they are doing there is, as I said, getting customers and clients far more familiar with the technology, with doing more and more things in and on digital platforms, and also becoming better educated in terms of how those recommendation engines work. I think we're very much at our infancy in many regards to really understanding why it is that we see certain adverts pop up on social media that are linked to perhaps how long we've paused on a particular Instagram or Facebook post. So I think more and more people are familiar now, but there's still a long way to go in terms of how that works. And I think perhaps the more financially savvy and financially educated of consumers will be more and more comfortable with that concept in wealth management.
Boris, what's your perspective? Do you see the industry fearful of these potential threats, or are they actually just using it potentially as an education and learning area where they can then adapt their own capabilities?
Yeah, I see I see it like them. So, it's kind of, they know that end consumers are expecting this kind of experience from these other companies or other industries, and they have to adapt to it. Of course, there is like new competition coming up, but I think not the biggest threat for banks and wealth managers. I think there's we are seeing a major consolidation going on in wealth management. For example, here in Switzerland, we have, I think, end of June 2020, there was a report showing that we have like 100 private banks in Switzerland. And 2010, so 10 years ago, it was 182. So there is a major consolidation going on. And this is the biggest, let's say, threat for most wealth managers and private banks, that their cost to service clients is too high, right? So that means that's the reason they have so bad cost-income ratios. So they have to utilize somehow technology to bring this cost down. At the same time, they also have to work on the income side. So how can they get new clients? And when you look, for example, private banks in Switzerland, if you want to become a client of a private bank in Switzerland, typically you have to have like at least 1 million, assets under management to bring to the client. And why is that? Because the cost to service clients is so high, right? So if you want to, on the one hand side, you have to bring down the cost. That's what I meant with increasing front office productivity. At the same time, you have to go into new markets, and there is like a big, market with the affluent segment. So everything below 1 million, and most of these assets are held in cash, so they are untapped by current, let's say, wealth managers. And this is like, I think, the biggest threat for wealth managers. That they don't manage it, to bring down the cost and to reach out to new markets, and not the competition they have to fear from Amazon and Facebook, I would say.
So there's a broad range of drivers, and I think we've now touched on perhaps the opportunity or where they should be looking. From your experience, how are banks or other forms of wealth managers integrating next best actions, and where should they be? So, what is the low-hanging fruit? Where can they make a start in bringing this kind of capability to their organizations? There's a lot of applications, a lot of potential. Where should they start to make some early wins? Dan, for you first, if I can.
Yeah, I think a lot of the existing financial institutions are sitting on large amounts of unstructured data. So I think the opportunity really is to look at customer retention, perhaps in the first instance. What can you do to really inspire those customers to perhaps take a different product or cross-sell something and really increase that level of customer stickiness. So I think any institution that's perhaps losing customers to some of the digital attacker or fintech brands that we've seen come into the market, that's definitely an area of priority that they could look at first, or the low-hanging fruit, if you like. And then I think after that, you move up to enabling your sales staff and your RMs with better information to then take a far more proactive view of getting in front of customers and proactively selling relevant and products and enabling them to make better choices. So I think there's probably on the more operational side initially, but ultimately where you want to get to is always approaching your client with fresh, relevant information that is ultimately increasing their loyalty to your company and increasing that customer stickiness. And I think that's where the biggest opportunity of next best action probably is.
So it sounds like extracting more value from the existing client base before thinking about winning new clients from different markets, different segments.
Yeah, we're seeing clients actually adopt a parallel strategy to cover both of those, but certainly from a quick win perspective, it's very much focused around retention and churn, and really re-engaging customers that have been largely quiet or silent for a number of months, perhaps years.
Boris, are you seeing similar in the prospects of the applications that you're having with clients now, or would you maybe be able to extend on where you see the application and where you see the quick wins?
Yeah, so I don't know if there are quick wins, you know. What I think is, like, you know, in recent years, there have been like lots of new regulations coming up in the banking world, in the wealth management context. We had lots of new regulations for investor protection. How can banks make sure that, you know, investors are protected from let's say misinformation, from too high costs, from financial damage. And, you know, in Europe, of course, this was MiFID II that was introduced, and banks had to introduce new systems, you know, to collect better data. Lots of the data was, you know, in paper format, in scanned papers. For example, the risk profile, and relationship managers didn't have an easy access to the risk profile information of their client. And this has changed because this regulation came up, you know. So the relationship managers have now to know about the client's risk profile, the current client risk in the portfolio. They have introduced portfolio monitoring rules, and they are getting alerts when there is like a suitability failure, you know, or there is like a breach in concentration risk, because that's contractually agreed with the client. So these first steps have been done, you know, to collect all the data and to provide this data on an almost real-time basis to relationship managers and financial advisors. And now, you know, if we can say there are some quick wins or low-hanging fruits, I would say let's now try to utilize these portfolio monitoring systems and alerts that are created due to regulatory reasons, and, you know, provide concrete actions for the relationship manager. So if there is a suitability breach, provide to the relationship manager what can he do about it with a concrete action. If, for example, a security in a client's portfolio is downgraded by the bank, you know, because the analysts have now issued a sell rating, or there was like a downgrading in credit rating, and you get an alert on your dashboard, then provide the concrete action. What is like, how can the client switch this security, you know, and in order to remediate this breach? I would say this is like would be one logical next step, how you can you know, work on the foundation you have built for all these regulatory implementations, portfolio monitoring, etc. How you can now do the next step and also provide actionable recommendations how you can remediate these breaches. That's would be just the first step.
Interesting to think of regulation actually as an opportunity in the right way, or viewed in the right way. Dan, just quickly on regulation, would a similar theory or status be true? We've had MiFID in Europe. Is there a similar environment in Asia Pacific, or not?
Yeah, there are variations, of course, of the MiFIDs of the world. I think, you know, advice in general is quite heavily regulated, certainly in Asia. But I think the dynamics are slightly different in the sense that wealth management, traditionally in centres like Hong Kong and Singapore, has a very face-to-face method of being done. So I think regulation in some instances is evolving, especially in those two markets around this. I think the use of machine learning, the use of data on digital platforms is absolutely a hot topic across all segments of the population. So I think most clients do see it as an opportunity, and they are actually working with regulators on a quite proactive basis. So I think that is definitely one positive that we've seen in Asia, whether the regulators want to work with institutions to develop that regulation. But there is a wide variety depending on which market you go to in Asia. You know, in Indonesia, for example, is almost a completely different ballgame to the likes of Hong Kong and Singapore. So any global wealth manager or bank really needs to have you know, a lot of things in its armory to enable a multi-market rollout of this type of technology, because the regulations are quite diverse.
Perfect. Thank you both. So we've got some very clear drivers and we've got some obvious opportunities, and it seems that in response to things like regulation, some of the infrastructure and technological tools are there to support next best action being delivered. What about, so where is the status of the market? Technology we know is very capable and can be applied in many different ways, and there's a lot of drivers for it, but the actual application and delivery and usage of it by financial institutions is often hindered by a wide range of factors. So if you look at wealth managers, large private banks, other forms of financial services firms that will service mass affluent clients, high net worth clients, and so on and so forth, where are they? What is their status today? Boris, what's your view on what they look like now?
Yeah. So as I said, we see like the major activities in front office digitalization. So making onboarding seamless, making it digital, providing tools to advisors to serve the clients better, have an overview of the book of business, having like a 360-degree view of their clients, and then also providing clients access to all the services through digital channels. So we see like a major activity there. And in this context, we have worked together with different banks in Europe, but also in Asia, to introduce next best action as part of this whole front office digitalization. Because as I said, like, when you have like 7x24 access to your portfolio, so advice can then basically happen anytime, anywhere, right? And banks are shifting from this passive model more to a proactive model, or they want to do that. Especially also because in the old world, you had like this execution-only brokerage model versus discretionary portfolio management. And within the execution-only or brokerage model, often the client was calling his relationship manager, wanted to do some trade, and at the same time got advice from the relationship manager. Without paying anything for this advice. But of course, the client paid the bank through commissions. So because the client was trading. This is shifting now because of regulations. You are not anymore allowed to provide advice within an execution-only or brokerage contract. But it's also changing because, there are like online trading portals with very nice UX, easy to handle, and of course, people are, even older people, they are used today to utilize digital applications. So with these applications, it's very easy to do self-service trading, and commissions go almost to zero. There are already platforms where the commissions are, it's for free to trade, right? So that means like you have these drivers to shift from execution only to advisory. And that means you have to be more proactive, right? You have to provide ideas on a proactive basis and not only waiting until the client is contacting you. And there we see like the demand from our clients that we can, with next best action, which is data driven, utilizing machine learning, but also applying rules. You can inject this personalized content into these different digital channels. In some use cases, you distribute this content to the relationship manager or the advisor, and he's taking it up with his clients. Let's say this is more for the high net worth and upper client segments. But for affluent and mass affluent, you even distributed this content directly to the different digital channels, where the clients or the end consumers can look at it, can browse the content, can interact with the content, they can like or dislike. So we had one client in Switzerland. It was implemented really straight through, so into the e-banking of the clients. When they logged into e-banking, they have seen trade ideas, and they then could click on the trade idea. They have seen some charts, some content, company description, for example, about the company, how the company did in the past, some news attached to this company. They could like or dislike this idea, or they could even trade it. And this interaction was measured and fed back into the system. And then the system, was retrained, and over time it gets tuned into the client's behavior and produces hopefully better recommendations. So we have seen these both use cases, for let's say affluent, mass affluent, you want maybe to distribute directly because there is like so large number of clients. And for high net worth individuals and upper, you distribute this or his personalized content and trade ideas to the advisor, and he can then take it up with his clients.
Perfect. Dan, do you have a perspective on that in terms of where the market is, and maybe adding on to Boris's points there of clear applications and use cases?
Yeah, no, I agree with Boris. I think when we talk to clients, almost all of them are in some way experimenting with this, but the application is patchy depending on which market and which subsegment you look at. But I think most institutions were familiar with using more of a linear regression model to do their predictive analytics. I think the challenge for them now is getting familiar and comfortable with the more the machine learning unstructured side of things. So we see different risk appetites, different cultures really in different institutions that are really determining how far that particular institution has got in applying this. Take Morgan Stanley in the US, for example. They've been very public about their aspiration to use machine learning and next best action across their business there. Some of the smaller banks, particularly in Asia and Europe, are taking a very cautious approach because there are, of course, a number of challenges and risks with automating advice. So it really depends on who you talk to, but everyone is looking at this. Everyone is experimenting in different ways. But what we see is that some institutions are far more willing than others to explore things like alternative data sources, utilizing device data, for example, in some of that decision making and in some of those models. So yeah, it's going to be an interesting few years, I think, in financial services as we see these come to market.
So, experimental. Does it depend on size? Do you have to be a large entity to make this work and to deliver all of the necessary pieces of the puzzle? Boris, touching on your point about the consolidation in the Swiss market, so a lot of smaller entities will have been exited, bought, whatever, they're not there anymore in some formats. Is it just the large players in the Swiss market or elsewhere that can play in this game, or can you do it as a smaller firm?
No, you can do that also as a smaller firm. Actually, we have also smaller clients. So, for example, private banks with 10 billion assets under management, which is quite small in that area. But then, of course, it's always like if you're a bigger company, then you think about, I have lots of echo.
Yeah, me too. I'm not sure about that.
Maybe if you go on mute, Stephen. Yeah, I think it's better now. If you're a bigger institution, you can think of course, making it by yourself, right? So hiring a data science team, setting up all the infrastructure and doing it by yourself. Even, that might incur a large cost, but you would have the ability if you decide to do that. For smaller wealth managers, this is not an option. And so they typically then work with specialized vendors like we are and others in order to provide like a cost-efficient solution for that. But this solution is also available for smaller players because also they have to, be compliant with all the regulations. So they have the data, they have it electronically available, and we can source that data. And they also have to use tools because otherwise they will not be able to serve their clients. So that's also accessible to smaller players in the market.
Do you have a similar view in Asia?
Yeah. I think it's not necessarily about the size of your organization. It's about the depth at which you can understand your clients and how you can interpret that data. So I think it's out there. The possibilities are out there, but it's really about the internal capability that you have. So if you're an existing organization that hasn't really ventured into this field much, you're probably not going to have armies of data scientists around, for example, to develop some of these models. So I think it's more about building that internal capability. It's about really getting an understanding of your client from some of these models, rather than the particular size of your customer base.
Off mute. Thank you. In the research we do among wealth managers, you often hear about the challenges and the issues they face, cultural, technological, staff, how they work, relationship managers, and how they're used to dealing with clients. What are the challenges that you see firms facing? Thinking of all of the things you've said already. When I think of how wealth management was historically, it was a private banker meeting a client wherever, doing a face-to-face conversation, paper-based. Technology was creeping in, but maybe not still very well utilized. And you think about the Netflix or the Netflixization of financial advice, that's quite a big journey. So what are the challenges that firms face in their delivery of next best action? Boris, what would you say their hurdles are?
Yeah, I mean, it's clear like the financial domain is much more sensitive than watching movies, right? Or listening to music on Spotify or browsing some Airbnb apartments. Whenever you recommend something to a client in the financial services domain, it's highly sensitive in terms of regulation, what you have to follow, but also in terms of potential damage you can do to a client because it directly impacts his financial well-being. So I think one of the biggest challenges to adopt recommendation technology into financial services is, of course, to be compliant with all regulatory requirements. So you always have to consider, whenever you propose a trade idea to a client, you have to consider what's the risk profile of the client. Does the client have knowledge and experience in this product area? We should not encourage clients to build up concentration risk. That when you watch some, let's say, you have some interest and you watch on YouTube some movies for a specific topic, you always get like the same topic recommended. You should not do that in financial services when you do advice. You should not, encourage a client to every month to buy more US tech stocks from Silicon Valley, right? And then he has 80% exposure into that sector. So you have to consider many rules whenever you propose something to a client, and this is, I would say, a big difference to the other industries, but it's doable. So, and how we have solved that is you have a pure data-driven part, which is analyzing the data and is providing you like information about the client's interests in different topics, let's say. And then you have a second part, which is fully 100% rule-driven, and you can basically make sure that whatever the system is delivering to the client is 100% deterministic and not like with many, let's say, machine learning or AI-based system where you have a 99% accuracy, right? And 1% you get something which is not working. So in the financial advice context, the system has to work with 100% deterministic output. And this is for sure one challenge. Second challenge I see is change, let's say, the whole change process or even a business model change, because many wealth managers and private banks have focused on high net worth individuals and higher. Now, to also serve the affluent client segment is also a cultural shift. You also have to be aware that the relationship manager might be less important in such a setup, right? And this is of course also within a bank. Relationship managers are very important because they have the clients. So the bank is a bit dependent on them. And if you want to introduce this kind of technology, you also have to convince always internal stakeholders. And the relationship managers are important stakeholders. So there is also, this change process that has to be managed, which I see also as a, let's say, not an easy task when you want to introduce this kind of technology.
Yeah, I mean, to add a few things, perhaps from the perspective of your existing financial institution looking to move into next best action, I think some of those challenges are really around, first of all, finding the talent, as I said before, with the data science people that can create some of these models are quite rare in many markets. So building that internal capability is your first challenge. But also your data typically is scattered across the firm, across multiple systems of record and databases, right? And bringing all of that together into a centralized data hub or a data lake is something that we're seeing a lot of financial institutions look at doing to enable some of those models to be more effective. I think traditionally as well, organizations tend to be siloed and centered around key wealth management products as opposed to around the customer or a particular channel. And I think that's something that will need to change as well as we really maximize the effectiveness of some of the next best action models that are coming out. And I think ultimately it's about getting to market with something in a safe way. Reputation is an incredibly fragile thing. And when you're talking about advice, obviously we have to be careful from a regulatory perspective, but also a reputational perspective, because one bad mistake can really set you back in a number of years. So I think we've seen a very cautious approach from some of the existing financial institutions, a very experimental approach. But I think the key thing also is that you don't have to create all of this from scratch. There are some fantastic tools and technologies that are in a way pre-built that will get you to market faster, that have proven infrastructure, proven ways of working, which allow you to take advantage of this next best action opportunity.
Perfect primer, thank you. So Boris, it'd be good actually to talk about some of those tools and technologies. So Dan touched on the idea of a client-centric view across an organization, so less siloed by product or offering. Also, data being in disparate places, it's difficult to integrate, but there are tools and technologies out there. So what can you tell us about what those tools are and how they function, and perhaps how they are integrated into an existing infrastructure?
Yeah, I mean, of course, in order to let's say implement next best action, utilizing machine learning algorithms, you have to have let's say a data infrastructure, right? So you have to store your data systematically. You have to historize your data so that we can also use historical data. And let's say there is some classic data like historical transactions, portfolio holdings, asset reference data, client data, risk profile data. This is all available in banks, and most of lots of this data is also available as historical data. And there is, like Dan already mentioned, like alternative data sets, and this is often unstructured data. And with that I mean like documents, advisory minutes, CRM notes, notes from complaints management systems where relationship managers are recording complaints from clients, where also lots of information is sitting. But then also all the click data you have in all the digital channels, which data is the client opening, which documents is the client opening, which email is he opening, etc. And of course, as an institution, if you want to utilize that data with machine learning models and also with rule-based systems, you have to store that data, and the data has to be of good quality. So you also have to have some processes and tools in place that ensure that the data quality is sufficient, because we all know garbage in, garbage out. So for machine learning models, this is a very important prerequisite. And then there is like the whole infrastructure, how you develop machine learning based models, how you put them in, how do you test them, how you put that into production. And as I said, depending on whether, as an institution, you have to say, is it a buy or make decision? If you want to make it by yourself, you have to have all these capabilities in-house. And it differs from classical software engineering, where you have, these development cycles, test cycles, and you put in production, and you have two times per year you have a release. Because in these systems, everything is fully deterministic. And with machine learning-based models, you have to introduce as well, like, how do you test these models? For example, concepts like A/B testing have to be introduced so that you can prove the value of this. You have to think about life cycle management of the models, because new data is coming. How often do you have to retrain the models? You have to take care of all of this if you are like building it by yourself in-house. If you're doing it with, let's say, a partner, a provider, a specialist provider, then they are doing it for you. But still, you have to make sure that you have collected all your data and so the data is in good quality. And the tools you are utilizing there is, classical machine learning algorithms like collaborative filtering. We use explainer models to provide also the explanation why a specific product has been recommended. We use A/B testing methodology. So all these classic machine learning based tools that you find in the market. As Dan said, you don't have to reinvent everything. So also this is a huge ecosystem in the with Python, TensorFlow, etc., where you can work with this let's say technology in order to create new use cases.
Thank you, Boris. Quickly, just one final question on that. So the buy or build piece, do you see institutions favoring one over the other typically? I mean, are they normally working with a range of external third-party vendors or suppliers, or are they insisting in the more traditional model of doing things themselves, or more of a mix?
We see both. So of course, very large institutions, they always think about doing it by themselves. So we know, like for example, in the US, Morgan Stanley has built that by themselves. But we also work with clients, with big clients who decided not to build it by themselves because they don't see that as a core, let's say, capability. They also want to use it, and it's not their core value proposition in building the technology for that, but they want to use that technology, and the core value proposition is basically their data, their service offerings, and their client base. They decide to work together with providers. And for smaller institutions, it's, I would say, almost 100% working with providers.
Thank you, Boris. Dan, a quick question on sort of use cases or examples or good things you've seen in terms of next best action with the clients or others that you've worked with in Asia Pacific or elsewhere. Can you sort of highlight some of the best things you've seen happen in the market so far?
Yeah, certainly. So I think I did want to look at is Morgan Stanley in the US. So they've been very open about their strategy and their approach, and they're looking to enable over 1,500 of their RMs and sales staff by next year with a next best action platform. We understand that that's been a combination of buy and build. Obviously, like most financial institutions, they've got quite complex legacy systems that require some elements of build. But their tool set is all about enabling those sales staff to make those more proactive recommendations, and in particular around alerts. So taking both client data and market data and creating several different alerts for RMs and sales staff to reach out to clients at different times. And I think we talked a little bit about success factors, and I think as customers learn more and more about these engines, they become more sensitive to the timing of those notifications. And I think getting that right and really hitting the client with that information at that right, precise and relevant time is key. So I think how Morgan Stanley get on in the market over the next couple of years will be particularly interesting. But they've certainly invested heavily in this area, and obviously are sitting on large data sets which they're combining with some of those external data sources that we also talked about. I think another quick example, also from the US, but increasingly they're looking to expand across Asia, is SoFi. So they've had a lot of success with that emerging affluent segment that we talked about. So a very digital platform approach to investment, and in particular investment education of customers who may not have that level of understanding of wealth management, but getting them into wealth management at an early stage, and then cross-selling, upselling, sticking with them as their needs and wants change, and hitting them with key relevant products at those moments of truth in their life is something they've done very well in the US. And they've recently made an acquisition in Hong Kong. I think predominantly because it's probably a market that traditionally has been served by that face-to-face model, and they see an opportunity there.
Thank you, Dan. So the market's in a stage of experimentation, so we'll watch and learn what happens with Morgan Stanley. Boris, from your perspective, strong use cases or examples that you've seen happen?
Yeah, with several clients, we have seen the challenge how to move clients from an execution-only brokerage model to advisory models, where you have the fees based on the advisory model, and utilizing next best action is a way also to incentivize clients to move to advisory models, because there they receive like personalized advice into their digital channels, which is not possible within the execution only context. And this helps them basically to provide, let's say, to enhance the attractivity, so to be like, have like a more attractive offering in the advisory space, so that clients are more willing to move from execution only to advisory.
I've got a sticky mute button. Hang on, I'm off it again. Perfect, thank you. Well, we're 55 minutes in. See, time always flies when we do this. So I think a final question to you both, just to summarize. So why? And basically a sort of maybe provocative question, but so why should wealth managers care? So what's going to make them move here? What do they need to consider to actually go down this route, make the best of next best action, and start to deploy it effectively? Dan, over to you. What would you say they should really be thinking about and caring about here to make them do something?
I think we have seen clients successfully use this technology to increase returns. So where they have moved beyond the experimental phase and rolled this out to a particular market or a particular segment, it has increased cross-selling, it's increased returns, but it doesn't come without risk. But, of course, we've talked about some of those challenges. So it does require a cautious approach, but the opportunity is absolutely there. The rewards are there, and I think those changing consumer behaviours and the huge increase in the availability of external data and different types of data sources, combine all of those things, I think the opportunity is there for the taking, and you only have to look at China and the success that people like Ant have had to really see the power of this technology in use every day.
Chris, to you, there's a lot to consider here. Clearly, there's a lot of elements. You mentioned the data elements, and there's such a broad range of data that is maybe required here to make this work. But from your perspective, concluding, why should a wealth manager care about next best action?
I agree with Dan. I would say, like broadly speaking, as a wealth manager, you have to be interested to reduce your costs to service your clients, and you at the same time have to be interested how you can increase your net new, let's say, assets under management and net new revenues. And next best action is not like the holy grail of that, but it's one important component that can help you to achieve both goals. So reducing costs, the cost to service clients, but also, tapping into new markets.
Thank you, Dan and Boris, for your time. Much appreciated. Next, an evolving area with a lot of complexity, but it's something that wealth managers should be considering, and it seems that many are in terms of experimentation and application. So thank you both for your insights and time. Much appreciated. I'm sure for those listening in and those who listen to the recorded version of this, both Boris and Dan will be willing to and interested in taking any more of your questions. So again, thank you both. Much appreciated. And we look forward to hosting you again on another WealthTech Talks in the near future. So good morning, goodbye, and we'll speak to you again soon. Thanks both.
Thank you, Stephen. Thank you. Bye.